talking about different types of insurance. And to start off tonight, I'd like to introduce Tracy Freeze. She is a licensed life insurance agent, and she's worked in the field, and she's going to be talking briefly on life insurance. Tracy.
So some of you have heard me speak already on the ad matching, but this is what I actually do for a living, is financial planning. And basically we're going to take what Finley has talked to you about with saving, spending, and getting a nice big goose, nice big goose egg, having a nice big nest egg. And what does it mean then to have that be at risk, right? And so I have a question for you. What is your biggest asset?
Your ability to earn an income.
You bet. Your ability to earn income. So what happens when you don't have a solid foundation around you, right? Because if you're your biggest asset, clearly we need to make sure that certain things are in place, okay? So a lot of these basic needs right here are going to be your food, your shelter, your safety, yes? So we're looking at risk management, we're looking at powers of attorney, who might help you in case of needs. Your risk tolerance, you've got your nest egg and you don't want to have it subjected to any type of market fluctuations or anything that is going to adversely affect what you're doing. Business succession, let's say you've made your nest egg off of a business. Well, maybe you need to make sure you have an idea of where that's going to go in the future. Now, I want to be very focused here on this risk management because that is insurance. What happens if you die? Guess what? We're all going to do it. Fair enough? Okay. So as you move up the stages of life, it's key for you to understand that your safety is your first layer, but then we're going to move on to like love and belonging. Like you've got some money now, you've worked a few years, maybe you're 10 years into your career, you're starting to have kids, you've probably gotten married, found a significant other, maybe purchased a house, you've done some of these things. And so you're kind of looking then at debt management, you're looking at cash flow management, you're looking at maybe doing some investing. Then we're going to have some wealth, okay? We're going to get to that point where we're more than comfortable. We're maybe in that luxury point where we're starting to be able to take vacations, maybe own a second home, all these things. So then we have to start looking at other things. Like we're going to look at diversification. We're going to check to make sure that we have all of our assets covered, all of our bases. And then at the very end, at the very tip of this, we're going to see what are we going to do to move it to the next generation or leave it to charity. But if you don't have your solid base, next slide please, it could look like that. So how do we fix that? To insurance. I want to talk specifically about life insurance on your life. We're going to look at other insurances probably later on in these classes with your home, your auto, all of those things stop your biggest asset from being destructive. You don't want to see that. So, because you are your best investment and you are what's going to be earning you the most money and the most wealth to get you up to that top of that pyramid, you need to make sure that your base is covered. Otherwise, you're going to end up with money and all of these things are going to start knocking you back down, right? So if you've got your base and your needs are being met, but then you start getting up high enough and your business all of a sudden you have a disability, and boom, you get knocked down, all of a sudden your base goes on top of the point and your wealth starts to be, obviously very precarious. It could fall. So the key point here is that as we move through life, you need to make sure that your notches don't have the ability to fall back down on you with specific insurances in place. So I want to talk very specifically about a product. My next slide, please. What if I could do both? What if we could talk about building wealth and insuring that wealth and insuring your investments? Sounds good? A variable universal life policy. This is the best of all worlds. I have to tell you that, term or permanent insurance, we'll get into the specifics more and more as we go on, but the variable universal life policy can do both. It is attached to the stock market, plus you're able to have the risk and the protection that you need. So what you're doing is you're actually being able to put money into this account and then overfund it. So let's just say all of you become the doctors and the attorneys that I know you're going to become, right? And you're going to start making that $150,000, that $200,000 a year. You could probably afford to put $25,000 into a policy such as this. Now, it's going to be attached to the stock market. It's going to grow. You're going to have the ability to move with risk tolerances. So if you're wanting to be less risky, you can make it less risky. If you want to ratchet up a little bit higher and take more advantage of the market, you can have more growth in that manner. And in the next slide, I'm going to go ahead and show you how this can be done, because that's just crazy, right? You would be able to retire on a life insurance policy. Next, please. So if we start at age 47, right? You're that attorney, you're earning good money. What we're going to do is we're going to take $25,000 and we're going to put it in for 20 years. At the end of 20 years, you are 66 years old, right? Time to go on to Social Security. If you've probably earned so much, you don't even need to worry about Social Security, actually. And so then, when we're ready to retire and enjoy the good life, we're going to come over to this one right here, cash surrender value, okay? And I'm giving you several options because the market does different things, right? We can't predict it. And so what I'm going to look at is, some non-guaranteed assumptions are about $726,000 is in this account. But then we're going to look at probably more realistic guaranteed values. And already we're looking at the $596,000. So at retirement, we can flip the switch and start drawing out $596,000, and your policy continues to grow, right? Because it's attached to the stock market, it continues to grow. But you could take out at least $50,000 a year, tax-free. Hang around to the end of the class, and you're going to hear more about how that works.
Thank you, Tracy. Thank you very much. You just got sold, folks.
Sounds good, doesn't it?
That was a life insurance pitch. That's what we're here to protect you from. That pitch is what comes from the life insurance industry. Now I'm going to show you a different pitch. It's a video, and it comes from something you would see in television. So, Tracy, if you would, hit the light for me. This is the video version of what you just saw.
Did you get that?
Lights, please. Marketing. That's what that was. Marketing plans that produce very effective advertising, whether that's through technology or through human beings. It is put together in a very pretty package to sell you. Don't forget that. Don't forget tonight. This is what you're going to experience out into the world beyond this classroom. Now we're going to get to life insurance in a few minutes. Yes, Tracy?
I want to point out something to all of you who have seen me do that last year. I know several of you saw it, and you were still taking notes, thinking it was totally different. I love it.
Yeah. It's very easy to get pulled into that. Believe me. And again, if you remember that first week, I got pulled in. I was a young man. I trusted this professional who knew what he was talking about. And it was a mistake. I was wrong. And I made that mistake because I didn't know what I was doing. I didn't understand much of anything about insurance. So the pitch sounded really good. So let's talk briefly about insurance. Specifically, the insurance machine, I call it. Insurance is a multi-billion-dollar industry. Billion-dollar industry. It's powerful. They have a great deal of money and influence, not only in their industry, but through politics as well. Specifically, when we talk about insurance, we're talking about risk. This is the part where nobody's pitching you anything. This is the teaching part. Understanding risk and mitigating risk is what you need to be concerned about, above all else. That's what insurance is about, is dealing with catastrophes. Think about that. Your goal is to deal with catastrophes. Not small stuff, but big stuff. Big stuff that can ruin your life. It can ruin all of your plans. It can devastate everything you've done up to a certain point in your life if you don't have the right insurance to protect you. What are the right insurance policies? 3 very specific ones: health, home, and auto. You're going to need those in different degrees as you go through life. It's important that you focus on getting them, getting the right ones at the right prices, using the right deductibles, which we'll talk about. Certain policies you must have to protect you and your family from devastating effects. Whether that be something that happens to you medically, tornado comes in and knocks down your home, you're driving a car and you get in an accident, it's your fault, and you possibly kill someone. Those things happen in life. You must have insurance for those things. They can devastate you. On the maybe front, you maybe will need disability insurance, long-term care insurance, or life insurance. We're going to talk about life insurance a little bit. But before I get to that, I want to talk to you a little bit about marketing. Right? I've talked about that briefly tonight. Marketing reaches our emotions. Tracy was doing that. That video was doing that. Think about how it made you feel. They try to reach that fear, that unknown. Come to the experts. You can trust us. We'll protect you. Not so sure about that sometimes. That's why it's imperative that you educate yourself so those marketing plans, go back to last week, we talked about advertising. So those marketing plans don't have such a big impact on you. Education insulates you. So marketing, access emotions. There are policies you do not need and should not have. An example would be flight insurance. You go to the airport, you have nervous tension about flying, and oh, there's some flight insurance. I'll protect myself because I die in that plane. Well, no. First of all, the chance of you dying is very slim. But if you need life insurance to protect your life, then you would have life insurance, not flight insurance. Same thing goes for cancer insurance. If you're concerned about dying from cancer, then you get the proper amount of life insurance, which is much cheaper and provides more value to you because life insurance covers life, not just cancer or not just dying in an airplane. Same thing with disease. You get all kinds of insurance on disease. Well, if your concern is your disability, then you might need disability insurance. You might need long-term care insurance. Or maybe you need life insurance. It matters what kind of disease is going through your head. But you also have to look at the risks. For example, you could buy earthquake insurance. I don't think that's a risk worth taking. I should say, that's something you probably should not be buying insurance on in Cedar Falls, Iowa. You live in San Francisco, California? Maybe so. You have to look at the risk in relation to that specific kind of insurance policy. Mortgage life insurance. Does anybody know what mortgage life insurance is? Anybody? This is where you buy a home, and right near the end of all that paperwork, you sign and you sign. Hey, you want to buy mortgage life insurance? We will pay off your mortgage if you die. It sounds pretty good. Okay, yeah. No. It's expensive, and it keeps going down in value as you build equity in your home. So as they have to pay less, that policy becomes more expensive over time. If you're concerned about a mortgage and if you died, you would buy life insurance. So again, you notice I keep coming back to certain kinds of policies. Focus on those big policies that provide the best value over many kinds of catastrophes at the best prices. Accidental life, same thing. If you're concerned about disability, long-term care, life insurance, focus on those issues, not on some accidental life. Terrorism, you can buy terrorism insurance. You can buy alien abduction insurance. You can. People own it. They do. And you think, well, that's just silly. Insurance companies would not offer it if people wouldn't use it and buy it, because they're concerned about apparently some aliens dropping by and picking them up. So, be watchful of those. Again, what's the risk? What's the likelihood of aliens coming down and snatching your butt up? I'm thinking it's pretty low. Okay? Even if you believe in aliens, I'm thinking it's pretty low. Same thing with terrorism. Yes, it could happen. There's a lot of things that can happen to us. But what are the odds? What we want to protect ourselves is from, as we look at the risks in our life, we mitigate those risks, but we can't mitigate everything. That's an impossibility. So we have to understand these things and look at them from a rational point of view and not let our emotions run wild as we try to protect everything or nothing. So it's very important not to let emotions drive our insurance decision making. Next up, deductibles. This is really a pretty simple concept. Almost always you want to be shooting for the highest deductible for your particular policy. Whether that be a health policy, cars, home insurance. The higher the deductible, the lower the yearly premiums. Deductible goes up, premiums go down, which means your yearly cost is going to go down as you raise your deductible as high as you can get it. $1,000 might be a regular high number, rather than $100. A lot of people have $100 deductibles because, hey, Finley, I don't want to pay any more than I have to. I have some kind of catastrophe. Yes, ma'am.
Can you explain what a deductible is?
You bet. A deductible is that amount of money when you have something happen. Let's say your home, you have damage to your home. You're going to cover that immediate amount of money, and the insurance company will cover the rest. So, if you have a $1,000 deductible and you have some kind of catastrophe that caused $50,000, you will pay $1,000. The insurance company will pay $49,000. But you're going to cover that immediate deductible amount, whether that's $100 or $1,000. Now, the average person, Finley, I'll just pay $100. I don't want to pay $1,000. But again, just like high deductibles, low premiums, low deductibles, high yearly premiums. Yes, ma'am?
Is the premium like how much you end up paying?
The premium is your, let's say, a monthly payment or a yearly payment to have the insurance. So, go ahead.
Because I got an accident summer and I had to pay the deductible and insurance for the rest, but it's at the point where like, because of the accident, my insurance obviously goes up. For like the next, I think, our insurance for 2 years, until like I'm like clear for 2 years. Is that the premium or is that just like the policy of the insurance?
The premium is what you pay on a yearly basis for that amount of insurance. A lot of times people say car insurance, you're going to pay that monthly.
Okay.
Same with a home insurance policy. That'll be tied in with your payment for your home and your property taxes. So generally speaking, when we think of premiums, we think of that monthly payment that we're making to the insurance company to protect us from catastrophes. Okay? And so if we raise our deductible, we're going to lower that monthly premium, so we're going to have more money in our paycheck to do something better with it. Not blow it at the mall, but use it to pay down debt, to build savings, to invest in our retirement accounts. So you think, okay, Finley, but if I got a $1,000 deductible, what happens if something happens? Well, we get it out of our emergency savings account. Next week we'll be talking about savings, but that's why we save. We put our money in a savings account for emergencies. That's the purpose of the emergency savings account. Probably fits the name. It's important to understand how insurance works. If you have an accident, they don't like that. No. So they may either raise your cost, raise your premiums, or they may even say, we don't want you anymore. Yeah.
Spray that when it happens.
Yeah, right. And if you file too many accidental injuries, that is what will happen. They will discard you. Then you might have to go into this thing called a high-risk pool, which you don't want to be in, I can promise you, because prices keep going up. So, we want to file as few incidents as possible with our insurance companies. And that means high deductibles. We cover the small stuff. If I have damage in my home, and it's a $500 issue, I'm not going to file any claim. I'm going to cover that $500 cost, and that'll be it. Because it's under my $1,000 deductible. So, and again, I go into my emergency account to do that. That covers the small stuff. Insurance is not for small stuff. Try to get, and this is kind of a way of thinking. Insurance is for catastrophes. Keep that in your mind. Make that a rule for you as you raise your deductibles, lower your premiums, and you handle the small stuff out of your emergency account. Inconveniences, the small stuff. This is where there is a ton of insurance policies out there for you. Any idea why there's so many of these little nicky-nack insurance policies?
Because people are willing to pay for it?
Yeah. And who makes a lot of money off them?
Me.
Yeah, the insurance industry. Multi-billion-dollar industry. They love those little nicky-nack insurance policies. So what ones am I talking about? Cell phone is one. Cell phone insurance. Yeah, I know. And I know some of you have it. I know you think, but Finley, I need it. It's fine. And I know in your world, that may be a catastrophe, right? I get that. But cell phone insurance is not in the catastrophe department. That would be one of the policies you would want to consider not having. Another one, credit card insurance. This is always offered to you. all the time. How's this work? Okay, only $1 a day or 30 cents, whatever. They have all kinds of gimmicks to get you to buy credit card insurance. We will cover your minimum payment if you're disabled, if you lose your job, blah, blah, blah. They make a lot of money. You pay a very expensive amount of money premium for that small chance of getting that insurance and making a claim. Again, that's a small thing. Avoid small thing thinking. Rental car insurance. We talked about this a couple weeks back, right? What are the 2 ways you can use that are free under most people for rental car insurance? 1, credit card. Most credit cards will cover it. You need to verify that in the benefits package. What's the other? Car insurance. Again, both those are free. Don't pay for rental car insurance. That means you got to know before you go there to rent. Don't wait till you get there and go, I think I'm covered, I'm not. Because if you're not sure, you're probably going to do it. Be sure. Extended warranties. These happen a lot. I was guilty of it with my car. That first car I bought, remember that first week? The salesman saw me walking miles away. Extended warranties are very lucrative for them, for the business. That's why they push them so much. They push, push, push. That should be that's when the radar goes up. Why is the business pushing this policy so hard on me? Ding, 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 ding. They make the money. It is very lucrative for them. They push the salesman, who push the policy, so the company and the salesman benefit very well, and they know that the chance of you actually making a claim on extended policy warranty is very small. Let's say it's 20%. They know those numbers. I promise you folks, they know exactly the percent of people who are going to make a claim on extended warranty. Now, any one of us can know somebody who had an extended warranty and they used it and it worked out well. That happens. But that's an anecdotal incident. That happened. Somebody you knew. Oh, well, I knew Joe and he... Those are individual incidents. Don't make insurance policy decisions based off, well, Uncle Joe worked out for him. The numbers are on their side, not your side. Focus on the big stuff, not the small stuff. Private mortgage insurance. Anybody know what private mortgage insurance is? This is when you do not lay down 20% of a down payment on a home. So you go to the lender and I want to get in a home, but I don't have much. So you lay down 5%. Well, you're a higher risk to the lender because you don't have much skin in the game, as they say. So you have to pay extra private mortgage insurance until one day you achieve 20% equity in that home. Don't do that, folks. Don't do it. We get to the week when we start talking about buying a home. I'm going to be telling you, lay down 20% on that home. Do not pay private mortgage insurance. If you don't have 20%, wait. It's okay. Don't be in a hurry to get stuck in a home that you feel stuck in. Many people do. Take your time, prepare, plan, make that the right home purchase, and do it without private mortgage insurance. Yes, sir?
If you do have private mortgage insurance, is the only way to get out of it is by paying off that 20%, or is there any other way out of it?
Not much that I know of. You're going to have to pay 20%. You have to keep track of it. The bank is supposed to notify you when you reach 20%, say, okay, you don't have to pay that anymore. I wouldn't trust them to do that, right? You keep track of that. If you're getting close, some people will have an assessment done on the home to say it's now 20%, so you can stop paying that PMI. So certainly, That's something you want to be involved in and not really rely on the bank, even though they are supposed to notify you of that, that threshold when you hit it. Finally, I say this a lot, pet insurance. Same thing. I guarantee you somebody has a pet and boy, I'm glad I had that pet insurance. I'm sure you do. I'm sure you know somebody who used their pet insurance effectively. It's overpriced, just like all other small policies. Don't deal with the small stuff, deal with the big stuff. If you have a pet emergency, just like all of these, it should come out of your emergency savings account. By not paying for these, you will have more money to put in your emergency savings account. By raising your deductibles, your premiums will go down. You will have more money to put in your emergency savings account. You got to build that up to protect you and your family from the small emergencies. The big emergencies, you've already covered. You've purchased those kinds of insurance policies that fit your specific needs. Okay, now I want to talk a little bit about life insurance. I bring Tracy in to talk to you about that because I believe it's one of the most oversold policies, insurance policies we have in America. Many millions of Americans do not need life insurance.
And they sure don't need life insurance that wraps their retirement account into it.
Yeah. But of course, a life insurance agent can explain very well, just like Tracy. They can talk to you, and pretty soon you're just hypnotized. Okay. It happens. Happened to me as a young
We
man.
get paid to do that and trained to do that, right?
Oh, so they get a lot of training on how to sell?
Yeah.
I'll be darned. It's very important to understand that a life insurance agent is an expert in their field, except I would argue their field really isn't so much life insurance as salesmanship. They're expert salesmen. They get a lot of training at it and they're good at it. And if you're not prepared, and that means educated, you've got to insulate yourself. And that education insulates you. Information that we're covering tonight. So, some good basic rules of thumb. Information you can find on my website on life insurance. You can also see videos under recommended viewing. If you're a single person and nobody relies on you for income, meaning nobody's going to feel financially hurt if you die, you almost never need life insurance. Now you may think, well, who's going to bury me? Well, okay. And save some money in your emergency account so your folks will cover the burial cost and you're going to help them. And I am not saying that people won't feel bad that you died. I'll feel bad. I'll feel bad for you, okay? And I'm sure your pets will feel bad. But we don't have life insurance to protect Fido. Because again, who relies on you and your income to live? If the answer is nobody, you don't need it. This also could apply to, say, a working couple. Man, wife, you both have full-time jobs, you're both making your own living, no kids. You may very well not need life insurance. You could be retired in your 50s, 60s, 70s. Both of you were basically taken care of. Maybe you're a single person at that age. You very well may not need life insurance. Only get life insurance if you need it. And I'll be talking about it a little bit tonight. But again, get that really squared right in your brain. Only if I need it. Because if you buy life insurance that you don't need, you are wasting money. Money that could be going to your emergency account, to your company retirement plan, to your Roth IRA. All of those things we'll be talking about in the coming weeks. So, if you need life insurance, sorry Tracy, don't listen to that pitch. What policy was she pitching?
All of those, I think.
Yeah.
One.
Yes, in one form or another. Those were cash value policies, meaning part insurance, part investment. I call it part insurance, part commission, because that's really what it is. It's a whole lot of commissions for them. That's why they pitch it so hard. That's why you're not going to hear about these term policies, which is where I would want you to go to. And I'll talk about them in a minute. But again, term is cheap. There's no investment. Cheap, cheap, cheap. Whole life, it's going to be very expensive. And I have an example up here for you. Because you have to cover that investment portion that provides a great deal of commissions to the life insurance agent. Which again, as I've said more than once, do not go to a life insurance agent to be educated on life insurance. Because they'll educate you, and they'll educate you on these kind of policies. Whole life, traditional, and variable. The high commission cash value policies. They make them a lot of money. If I made $3,000 selling one kind of policy, or $150 selling another, what policy do you think I'm going to sell? Don't have to be a brain surgeon to figure that one out. That's the system that we have going in America. That's what the life insurance agent, that's the position they're in. $3,000, $150. Okay, there you go. You need this. So, these are the main culprits. You want to be careful. The insurance industry, they are smart. They are creative. They will keep coming up with different names, colorful names, very interesting and better. You need to focus on, is this an investment? If it is, you don't need it. Because investment equals high commissions. They go together. If you need insurance, I would encourage you to look at term insurance. Specifically, level term policies or ARPs. A level term, think of it as a 5, 10, 20-year level term. Meaning, let's say a 10-year level term, you would have the same price premium every year for 10 years. It would not change. A 10-year level term stays the same for 10 years. Why would you choose 10 years? In your mind, you've looked at your particular situation. You may think, I need life insurance for 10 years. I may not need it beyond that, so I'm going to get a 10-year policy. In your mind, you may think, I need it for 20 years. So you may get a 20-year level term policy. You may also think, you know what? I think I only need it for 3 or 4 years. If that's the case, you may get an ART, annual renewable term. Annual renewable term. It automatically renews every year. And it's going to be the cheapest from the start, and it'll gradually go up ever so slightly as the years go on, because you're getting closer to death. Sorry about that. So, that's pretty simple, really. In other words, I just told you the right kind of insurance policies to buy. The question is, how do you get them? Because I don't want you going to the life insurance agent. Right? Yes, ma'am?
Just to clarify, so if you want long-term life insurance, then you suggest going with the level insurance?
Long-term care insurance is different than life insurance.
Oh, that's right. Okay, so there's long-term care, and then there's life insurance. But so the ART is for like short periods.
1 year.
Okay, so and that is level for longer then?
Yes, level would be for say a 10 or 20-year period, and it would stay the same for that amount of level period of time, 10 years or 20 years.
So that just like saves you money mainly than having.
Right, you're kind of locking it in.
Yeah, than having a whole life insurance.
Yeah, that's just crap.
Yeah, you said.
Right, right. And believe me, I mean that. It's crap. I have no time for whole life policy. There is no discussion on that. If you want to discuss that, talk to somebody else. Because I'm going to tell you to stay so far away from whole life policies, it's just ridiculous. They're overpriced, and the insurance industry makes a ton of money. Yes, ma'am.
You said get life insurance if you need it. What do you mean by if you need it?
If somebody relies on you to live financially, so you make money and you're taking care of a child, maybe you're taking care of a mother, somebody is going to suffer financially if you were to die. That's a pretty clear description. Okay? And notice here, I'm just really talking to you in a very rational tone of voice. I'm not talking about emotions. I know there's a lot of difficulties that come with death. I'm not using those emotions. I'm talking about, let's look at this situation from a financial standpoint, what's best for you and the people you leave behind. History.
Why is it cheaper for term and more expensive for whole life?
Well, in the simplest terms, that term, you're not paying all those commissions, for one, but I'm going to describe some prices here for you. But before I get into that, where to go? Again, I don't want you to go to a life insurance agent because they're going to talk you out of this. That Finley guy, he doesn't know what he's talking about. And they're going to sell you this, and they're going to be smooth, and they're going to be good salesmen. So I want you to educate yourself through independent sources. People like Jane Bryant Quinn and Eric Tyson. Eric Tyson with the book Personal Finance for Dummies. Jane Bryant Quinn with the book Making the Most of Your Money. Both books you can find on my recommended reading on my website. Teachers, not salesmen. And they're going to tell you the same thing I'm going to tell you. Go to term clearinghouses online. When you do that, nobody's going to try to sell you those cash value policies. What they do is they search throughout America, and there's multiple clearinghouses. They're going to search and try to find the right policy for you. And they're going to try to get that price as low as possible because they're competing with all these other clearinghouses. 3 basic names of clearinghouses would be AccuQuote.com, TermForSale.com, and SelectQuote.com. Those are 3. There are many. Yes, sir?
How do the clearinghouses make their money?
They make it, first of all, when you go there, it still has to be signed off by a life insurance agent. But they're doing it through a lot of connections with all of these insurance companies, and they're not paying those salesmen to walk around and sell it. They don't have salesmen with the overhead in offices and buildings, so they're not paying those kind of prices. So that's part of it. But that business model is working because more and more people are going to those clearinghouses. It's becoming a bigger and bigger business. Yes, sir?
So that's how they make money. How does an actual salesperson make money then? Because it seems like you're not paying as much as what they're giving you back.
That's correct.
How do they make money?
Well, they don't make much. They're not going to make much off you. That's why I want you to go to term. And that's why this salesman in person has no real time or energy to talk about term. So again, that's why the salesman, it's not that they're bad people. But they're in a situation, $3,000 commission, piddly little $150 commission. So they're always going to be focusing on that $3,000 commission. And they're going to sell it to you in a very effective way. So if you need term, go to those clearinghouses. Again, you can see a list on my website. There are many out there. I'm not here to say one is better than the other. I'm not really convinced anyone is better than the other. Find one that fits your needs. How much? Well, this is also kind of it's not a perfect science. Good rule of thumb, 6 to 10 times your yearly income. For example, you make $50,000 a year, and you're going to have insurance on you. Let's say your wife is at home with 2 kids, and you make $50,000. Well, you would have at least 6 times that amount, which would be $300,000, or maybe up to 10 times, which would be $500,000. That is actually the easy part. The harder part is teaching the people you leave behind, because that's what this is for, teaching them what to do with that money. What would that wife do if you died and somebody came and said, here's $500,000 cash? I'll tell you who's going to be visiting her. A lot of salesmen ready to help her. You have to protect her. You have to protect your loved ones, not just getting the right insurance, but teaching them what to do with that money. Giving them resources to go to help them. It's really important. That's something that really isn't talked about that much, even in your financial books that I recommend to you. Help the people you leave behind. Teach them what to do with money, not just protect them. Let's take a look at an example. We got a 25-year-old male, makes $50,000 a year. He goes out to the clearinghouse, picks up a $500,000 policy. He does everything right. He decides he needs a 10-year level term, so the price is going to stay the same for 10 years. Or he goes to his local life insurance agent and picks up a whole life policy. Got these quotes, they're real. And whole life policy per month would be $400 a month to get that $500,000 that he needs for his family, his wife, and his 2 kids. A term policy cost him $24 a month. $24 a month, or $400 a month. So for the year, a whole life policy is going to run you $4,800. Term policy, $288 for the same amount of insurance. For 10 years, because that's how long you think you needed the policy, $48,000 for that whole life policy. $48,000. The term, $2,880. That's a difference of $45,120 that you could have used to increase your investments in your retirement accounts, in your Roth IRA, in your emergency account, pay down debt, do something effective with it far beyond some whole life policy. So your family is still protected from your risks, from your catastrophes, and you're using your money effectively, wisely, to grow it, something that it's not going to do with that whole life policy. Because after 10 years, you put in that $48,000, you're thinking, oh, it's an investment. It might be worth maybe $48,000. In other words, it's very easy to earn 0, 1, maybe 2% in those kind of policies because all those commissions, they come out in the early years. They nab those commissions as fast as possible before you start to get smart and educated on this life insurance stuff. So, think about insurance as a way to deal with catastrophes. Think about your emergency account as a place where you put your money to protect you with the small stuff in life. And if you need life insurance, pick up the right stuff and avoid the wrong stuff. Spend your money wisely, but you don't waste it. Questions on insurance? Yes, ma'am.
So when you're choosing policies, and I'm assuming that you can say, okay, there's this policy that has X deductible, you pay this deductible, Y deductible, and Z deductible, and you get to choose which one you want. Is it possible to choose X deductible, and then over time, that deductible will, like, accumulate or raise, like, get higher or something like that? Is there a way to raise your deductible as time goes on?
Generally, they're going to have a specific high deductible. $1,000 will kind of be the norm. So that's not going to change unless later down the road they may offer a $2,000 deductible. But what you just said is exactly what you want to do. You put out a piece of paper. This is what the premiums are for a $1,000 deductible. These are what the premiums are for $500 and for $100. And look at them. And you're going to see a pretty big difference in your yearly premium cost by simply choosing that higher deductible and taking on a small amount of risk, which you'll access your emergency account to deal with if that happens. But your goal is to file as few claims as possible in your life.
Is it possible for the deductible to go down the more claims you...
Well, what's possible is the more claims you file, they'll just drop your butt.
Yeah.
Yeah, they'll say, hey, thanks, get away. I'm sorry, right? That's what happens. Insurance companies, they make money by you paying your premiums and not filing claims. Thank you. You keep filing, we don't... Let's go over there to the high risk group, right? That's kind of how it works. But that's why, with this basic strategy, you're filing only a minimum amount of claims in your life, hopefully. Yes, ma'am.
I have a quick question about the premium reduction. I just wanted to make it quite clear that when we choose the low premium, it means that our payment to the insurance company is low, or the things that the result that we get at the end, it will be low.
You choose the high deductible, so your premium will be low.
Yes.
That's the goal. And so you still have the same amount of insurance, right? No matter what deductible you choose, the amount of insurance you have stays the same. The difference is the deductible will either increase your premiums if it's low, or decrease your premiums if it's high.
Okay, so we prefer to have high deductible and low premium for us.
Exactly. Because that premium is your yearly cost to have that insurance policy.
Thank you.
Okay?
Yeah.
Anyone else? Okay, well, I wanted to remind you, before we get to the question, again, the bag, right? I'm always big on this bag. This is our bag of supplies. It's important, right? I'm building up this bag. You should be building up your own supplies. Things we've covered, right? The net worth statement, the spending plan. This should be in your bag. The financial plan. Understanding credit. Avoiding debt whenever possible. Understanding advertising and how it affects you. Learning the benefits of giving. And finally tonight, understanding life insurance and basic understanding insurance as a very big picture as you deal and protect yourself from catastrophes. And again, as a reminder, this is our bag of supplies that we're taking on this journey. It is a journey. We've got to fill this up. We've got to continue to feed that bag, and it's going to continue to feed as this semester goes on. So stay with me, folks. Ready for the question? Yes! let's go. Question of the night. Okay, we have some new people. Okay, so just to clarify, I will ask you the question. Make sure you put your name on it. Right? Put your name, your answer in there. I'll draw the hat. If I draw your name and it's the correct answer, you win $100. In the second half hour. In the second half,
40.
40. We're going to be giving away $40. Tracy and I will be here, and we're going to be talking about life insurance.
And you can ask all the questions about commissions, and I'll tell you the dirty secrets. How about that?
There you go. So, and I promise to get you out of here by 7:30 at the latest. So, we're going to be talking, that's in the second half hour. The $100 question is, what question must be asked to identify whether you should buy a life insurance policy? What question do you ask yourself before you buy a life insurance policy?